We know you're anxious. There's lots of uncertainty, and it's easy to invest on sentiment. But fundamentals are strong, and we're going to talk about that and a whole lot more right now on UBS Trending. Hey everyone, and welcome to UBS Trending. I'm Anthony Pastore. Thanks for joining us today. In the studio with me, my guest is Brian Mulberry, Client Portfolio Manager from Zacks Investment Management. Brian, nice to have you join me. Good to see you.
Good to see you. Thank you so much.
Of course. I feel like this is one of those conversations where we could go in a million directions, but I wanted to kind of start with you because let's kind of get down to brass tacks. I think what we're seeing right now, and we're all sitting in this time where this Iran conflict is happening. We're no strangers to geopolitical conflict. Russia-Ukraine has been going on for a while. We had COVID in 2020. We had Liberation Day in April of 2025. What are the let's take that out. But there's strong fundamentals there. Talk about what the fundamentals are telling us, where we can kind of maybe push aside the reactionary headlines that are literally happening on our TVs and phones multiple times throughout the day.
Absolutely. You know, the world seemed to change on February 28th, which is when the Iran conflict started. And that's where we saw more of an emotional reaction, this sentiment change in the market. But we do have evidence of the economy up to that point. And that's why the market was still climbing, still going higher after 3 years in a row of strong returns. And that's because the fundamental nature of the economy is still strong. The labor market is resilient. Unemployment is low. Wages are still growing. Prices are stable, not as low as somebody like the Fed would want them to be, but they're not terrible. And we are seeing other things like retail sales that came out yesterday still going higher. So the resiliency of spending and the consumer is strong, and that does drive positive growth in things like GDP over time. So all of that as a backdrop leading up to what happened at the end of February was why the market was still going higher. Now, one of the reasons the market is still technically strong and come back to where it was after the sentimental lows for the conflict in Iran is all of those facts are still true,
right,
and we can still prove them at this point.
Yeah. And looking at, so our chief investment office here, looking at the equity markets, does have an attractive rating. Obviously, they say be diversified, but they're looking at healthcare, tech, AI, energy, even financials as places to put money to work because the fundamentals are so strong. So when you take the sort of sentimentality out of that trade, Brian, and again, I want to dip back into, I read one of your recent white papers talking about how Liberation Day from April 2025, initially the reaction was very negative on the equity side of the markets, but then quickly turned around. And I said even 2020, in March of 2020, when COVID first became the headline, the markets initially sold off, but anybody looks at that chart for the S&P from April on, there was strong growth there. So just kind of give us a sense of when the fundamentals are really in focus, where do you want to be positioned?
Absolutely. You really just want to follow the money. I mean, and at this point, the strong growth in GDP is durable because it's backed by business investment, not government spending. That's not always been true in the last 5 years. We've seen a lot of government spending create a lot of jobs, but that becomes very uneven and it's not as productive capital. So the fact that now it's the business investment that's driving GDP. Just think of the hyperscalers spending $650 billion this year alone. That's real money that's showing up on the balance sheets of a lot of different companies. So that's real productive capital causing the growth. It's causing the growth in the job market. It's also causing growth in other things like productive technology, AI, adding to productivity and things of that nature. So the real spending, the real investment is what adds to the durability of that fundamental picture right now. It makes it incredibly strong in this moment.
What do you say to viewers, investors who are out there saying, fine, Brian, that sounds great, but I'm still really nervous and I'm anxious about what could potentially happen with the Iran conflict? There's talk that if they don't open the strait anytime soon, in Europe, airlines may have to shutter many flights. They only have 6 weeks worth of jet fuel. That could be an economic impact in a negative way.
Sure.
What do you say to those people who say, I'm too anxious to even think about investing right now?
Well, and believe me, what you've described in terms of the sentiment in the market, it has gone to extremes immediately. And I think COVID did reshape people's minds in that the worst case scenario. I don't think anybody ever thought that you could close down the global economy for a period of time and have everything come to a grinding halt. So now everything feels like COVID again when one of these events happens, right? You talked about Liberation Day. The market and the sentiment went and priced in maximum tariffs for the maximum period of time. The rest of us understood that this was just a bargaining chip and that there would be a normalization once real trade agreements came into place. And so that normalized over time, and that allowed the market to come off of those worst case scenario lows in sentiment. Same thing is happening right now. The worst case scenario is that oil is going to be $200 a barrel forever, and that's going to have a material impact on the global economy. The reality is, in the immediate term, yes, the 1 month forward contracts are volatile because we have this conflict that's still ongoing. But if I look forward 9 months, it's back down below $80 a barrel, right? So the market and the fundamentals of the market are telling you that access to these products will open, and it will open sooner than later. So yes, there's short-term pain, there's a lot of uncertainty, and again, because of how we got rewired during COVID, I think everybody goes to that maximum level of negative sentiment, and that causes this pullback. But now when that worst case scenario does not materialize, it allows the market to return to fundamentals, and that's why the markets are back up to where they are.
Right. And one of the probably the biggest disclaimers that every single financial services firm in the world has is past performance is not an indicator of future results. But if you do look at the history since 2020, I think that was such a boon. It was such a watershed moment where markets did react negatively and then fundamentals took over, where we all thought, I think in March or February 2020, oh my gosh, look out below.
Yeah.
But it didn't go that way. And then again with Liberation Day and what we're seeing now. So I think, you do have to kind of look at history to understand that there are potential positive paths down the road. So you talked about following the money, Brian.
Yeah.
Where are you following the money right now? Because if you look at value stocks versus growth stocks, we have a neutral view on both, but value has outperformed growth by 8 to 10% or so. Where do you see some opportunities here?
Well, again, that transfer of capital coming as an investment from large cap tech, which is in the growth side, over to things like industrials, durables, manufacturers. Just look at anything that's in the construction, mining, materials type of space. We need those materials and the expertise to build data centers, right? If Microsoft needs 100 data centers, they're very large spaces. You're going to need to move a lot of dirt. So even things going down to like John Deere, Caterpillar, those types of names that just move dirt, they're benefiting from that investment. You just look at their backlog of orders, and that's where the revenue is going from one side, which is growth that has driven the market for the last 3 years, to a point where they have this revenue that they can invest into future growth, and it's showing up in these other balance sheets. So even just the mining companies that are out there, not just looking for gold, but also other metals. Iron ore is up because we're going to need steel. Copper is up through the roof. Even silver becomes an industrial metal at some point in time. So you're able to kind of follow that revenue invested into the growth of revenue and earnings in all of these other sectors.
Right. I always remember this story that somebody told me, is that when you go back to the gold rush in the United States back, hundreds of years ago, it was the people who were actually selling the picks and the shovels who were making out really well, because you were guaranteed to sell it. Meanwhile, you went out with a little pan and you weren't guaranteed to get some gold. So infrastructure has always been a huge part of success and then driving business growth. So thanks for sharing that with us, Brian.
Absolutely.
On the risk side, though, because obviously there's always a risk, what do you see right now as places that maybe you're avoiding or keeping a close eye on, is a better way to put it?
Well, sentiment works both ways, right? And so this market also has a tendency to price in the best outcome possible. And so that could drive a lot of positive momentum in a short period of time. The risk would be at some point Microsoft says, we have a new wave of technology that is incredibly efficient. We don't need 100 data centers. We only need 50. And so that means that their actual investment becomes half of what they've committed in this period of time. Now, is that likely? No, because the one limiting factor to AI and the growth of AI is compute. We don't have enough compute. We need the data centers. So at the moment, we can fundamentally back up the story and say they have to build these things. But we don't know what we don't know. If there's a wave of innovation that comes along, quantum computing, something like that, that says, hey, we can do so much more with way less, data needed, then that would be disruptive to the value sectors that we just talked about, because the capital committed would be less than what actually lands on their balance sheet. So we're aware of that, but you just look for different ways to verify that demand for computing power is out there. And anybody in Silicon Valley right now is just complaining about the cost of tokens, right? And tokens is just another way to say compute. If tokens are expensive, that means demand is high. The rest of this should still follow the path that we're on.
Yeah, I love the kind of open-endedness. Obviously, technology has always been that way, and it's hard to see exactly where it's going. But as you just described with quantum computing, I mean, that's literally a game changer in the tech industry, and obviously all of the other components of where tech leads, which is everywhere. I mean, everything is some adjacent to technology and AI. It's fascinating to see where it's going.
Absolutely.
Yeah.
And it's a cold fusion kind of a moment, right?
Where
you're trying to provide endless power on a nuclear level without the boom. Right? And this is exactly where quantum computing is. They've been able to do this, I think, mechanically a couple of different ways, a couple of different times, but they cannot sustain it in a way that's commercially acceptable. So you never know when that moment is actually going to become viable, which would then lead to the disruption and everything. But again, you have the sentiment, best case, worst case, that keeps tugging, the market back and forth. We want to go back through and just follow the real earnings and the real profitability, and that will tell us that, the scale has arrived, that this is going to be a real moment that transforms the economy.
Excellent. Brian, thanks very much. Good to have you come through. Love to have you back again. Obviously, there's a lot going on, and we could probably talk more about this for hours.
Absolutely.
Good to see you. Brian Mulberry from Zacks. Thank you very much. And thank you all for joining us. There's a lot more information coming out of UBS and our great partners like Zacks at ubs.com/views. That is our Insights website. Plus, UBS is on social media. We're on LinkedIn and Facebook. You can also check us out at Instagram. The studio does have its own channel there at UBS Trending. So give us a follow when you have a chance. And as always, if you have any questions about what Brian and I spoke about today, please make sure to continue this conversation with your financial advisor. Until next time, I'm Anthony Pastore. Have a great rest of your day, everyone. And remember to keep your eyes on what's trending. We'll see you soon.